I actually think the jobs numbers weren't that bad, and I don't know why there was a lot of fear over them. I realize that some of the private payrolls weren't as exciting as we expected them to be, but to have an unemployment rate below 4% at this point and getting there this quickly is a pretty big deal. And really what the market was looking for was, is there anything in this report that changes the Fed's speed, that changes the Fed's reaction? And I think the answer to that is absolutely not. I think the Fed is going to have to continue to focus on inflation first and foremost. We'll get CPI numbers obviously later this week. I think those numbers are going to be hot again. And I don't think it changed anything about what the Fed is planning here.
That's an important point. We've seen technology come under pressure last week, all through the week, but then again this morning with the NASDAQ stocks down once again. Has the market kind of figured out, or has the market priced to the point that you could be seeing 4 interest rate hikes this year alone and a tightening of the balance sheet at the same time?
Right. So I think you have to actually start with the 10-year yield. And we've seen a 25 basis point move in the 10-year yield upward since the beginning of this year. That is an aggressive move that happened a lot faster than I think any market participants were expecting. And that's what the indices are reacting to. Now, the NASDAQ down more than the S&P and more than the Dow based on that move makes sense. I like it when things move and they make sense in the pattern that they're moving. When you look at what's happening to the S&P, which is a much broader representation of the market, down 1.87% year to date, that's hardly a big deal considering 70 new highs in 2021, right? So we're coming off a pretty good base, and we came into 2022 a little bit less strong than we went into 2021. We only had about 75% of the S&P trading above its 200-day moving average, but that's still a strong position.